Welcome to today's Explainer. If you love digging into the true underlying quality of a business, you are absolutely in the right place. Today, we are bringing you a rigorous, data-driven look at GSK's 2025 annual performance. We're going straight to the fundamentals, top-line revenue growth, the economic moat created by their research and development, and exactly how management is allocating capital. Are we looking at a business executing effectively on its strategy and generating real shareholder value? Let's find out.
Now, before we get swept up in the massive numbers, let's quickly bust some financial jargon so we can accurately measure their actual growth without currency distractions. Throughout this explainer, we're going to look at growth through the lens of constant exchange rates, or CER. In 2025, the British pound was particularly strong against the US dollar, which creates an adverse currency impact on paper. By using CER, we strip away those fluctuating exchange rates to see the true organic momentum of the company. It's really the only way to genuinely gauge if the underlying business is compounding its intrinsic value.
Here is our roadmap for today. First, the 2025 big picture. Then, we'll look at what's driving growth, specifically specialty medicines. Third, we'll check in on vaccines and general medicines. Fourth, capital allocation and debt. And finally, we'll wrap up with the 2026 guidance and outlook.
All right, part one, the 2025 big picture. We're exploring GSK's top-line performance and R&D momentum. Let's dive right in. When assessing the quality of a multinational pharmaceutical giant, we first need to see if their products are driving durable top-line expansion. The absolute headline figure for 2025 is a staggering £32.7 billion in total sales. And remember that CER metric we just talked about, at constant exchange rates? This represents a highly robust 7% increase. In this industry, generating a 7% organic top-line bump on a base of over £30 billion requires some serious operational delivery.
But you know, top-line revenue only tells half the story, right? We have to look at profitability. Total operating profit jumped over 100% to £7.9 billion. Now, you might be wondering, what caused that sudden, massive spike? Well, the filings show a mix of factors. Lower significant legal expenses compared to last year, lower contingent consideration charges, and higher other operating income. But here's the kicker. Even when we strip out those one-off items to look purely at core operating profit, we are still looking at a very impressive 11% growth at constant exchange rates.
Ultimately, a pharmaceutical company's economic moat lives and dies by its pipeline. The numbers we just saw are the result of past research, but we always have to look to the future. Behind these financials is a robust research machine actively securing future revenue. In 2025 alone, GSK secured 5 major product approvals and started 7 pivotal trials. Add to that 17 assets in late-stage phase 3 or registration and 58 total pipeline assets. Management is clearly demonstrating the scale needed to consistently commercialize new innovations. Moving on to part 2, driving growth, specialty medicines. This is the real engine behind the 2025 numbers. To truly understand this business, we need to know exactly which product lines are generating the most cash. Seeing how that £32.7 billion is carved up reveals it's not just a monolith. It's effectively 3 distinct businesses. Specialty medicines is the biggest piece of the pie at £13.5 billion, followed by legacy general medicines at $10 billion and vaccines bringing in $9.2 billion.
Let's zoom in on that leading specialty segment because the growth rates here are absolutely staggering. Oncology saw an explosive 43% growth, bringing its total to £2 billion. Respiratory and immunology soared 18% to $3.8 billion, and their HIV portfolio, which is a massive cornerstone for the company, grew by 11% to reach £7.7 billion in sales. This isn't just single-digit crawling, we're talking about double-digit aggressive market expansion in high-margin categories.
So the big takeaway here is that this high-growth division is aggressively driving the company's profitability. A 17% overall increase across a £13.5 billion portfolio fundamentally shifts the earnings trajectory of the entire enterprise. It clearly shows that their focused investments in these complex, specialized treatments are paying off handsomely.
Okay, part 3, vaccines and general medicines. Let's examine the remaining pillars of revenue.
While specialty medicines are definitely soaring, we have to make sure the rest of the business is holding up its end of the bargain. The vaccines division pulled in £9.2 billion, marking a solid 2% growth. Looking under the hood, Shingrix is doing the heavy lifting here, generating $3.6 billion on 8% growth. We also saw meningitis vaccines jump 12% to $1.6 billion, and Arexvy chipped in $0.6 billion. It's a stable, highly defensive revenue stream that provides incredibly predictable cash flow. Now, it's really important to contrast that double-digit growth in specialty fields with what's happening in general medicines. That legacy segment actually saw a slight 1% decline overall. But don't write it off just yet. It still brings in a massive £10 billion in revenue, providing tremendous scale and cash generation. Plus, within that segment, some drugs are still growing. For instance, the asthma and COPD treatment Trelegy actually grew 13% to £3 billion. So while it is a mature segment, it remains a highly valuable cash cow that helps fund the rest of the enterprise.
Let's shift gears to part 4, capital allocation and debt. Basically, where is all this cash going?
If you're analyzing a company's financial prudence, capital allocation is where management truly shows their hand. Are they hoarding cash, diluting equity, or rewarding shareholders? Well, that strong operational performance we just covered translated directly into a payout raise. The full-year dividend was bumped up from 61 pence per share in 2024 to 66 pence per share in 2025. And they've already guided an expected dividend of 70 pence for 2026. That is a loud and clear signal of confidence in their ongoing free cash flow generation.
But dividends aren't the only way they are returning capital. Management also launched a massive £2 billion share buyback program. When a company buys back its own stock, it reduces the total share count, meaning every remaining share has a larger claim on future earnings. It's a classic move that compound growth investors absolutely love to see, provided the balance sheet remains strong.
And this is where it gets really interesting. Despite returning all that capital and making strategic acquisitions, like buying IDRX to strengthen their pipeline, their balance sheet remains incredibly secure. Yes, total net debt increased slightly to £14.45 billion, but because their core earnings, measured here as EBITDA, also grew to over £11.2 billion, their debt-to-EBITDA ratio barely ticked up, moving from 1.2 to just 1.3 times. For anyone looking for a margin of safety, maintaining a leverage ratio well under 2.0 times while funding massive R&D and shareholder returns is a huge testament to excellent financial prudence.
Finally, Part 5, 2026 Guidance and Outlook. Let's look beyond the current fiscal year.
A great 2025 is officially in the history books, but as we know, the markets are always forward-looking. CEO Luke Miels set a very confident tone for the upcoming year, emphasizing that 2026 is all about operational delivery. They have the pipeline, they've made the acquisitions, and now the focus shifts to successfully launching these new medicines commercially and continuing to accelerate their research and development.
And they backed up that confidence with hard guidance. For 2026, they expect steady, single-digit growth across the board. Turnover is projected to grow 3 to 5% because of an improved product mix favoring those higher-margin specialty medicines and ongoing operational efficiencies. They expect core operating profit and core earnings per share to actually outpace revenue, growing between 7 and 9%. But perhaps the most striking number in their forward-looking statements isn't even for next year. It's for the end of the decade. Management reaffirmed a highly ambitious long-term outlook to exceed £40 billion in sales by 2031. It's a massive target, and it really underscores their deep belief in the durability of their current pipeline and their ability to continuously capture market share over the next 6 years.
Which brings us to a final provocative thought. We've just seen a company operating with conservative debt, aggressively returning capital to shareholders, and pivoting powerfully into high-growth specialty medicines. But the pharmaceutical industry is notoriously complex, with older, legacy medicines naturally shrinking and the specialty portfolio doing the heavy lifting. Will GSK's pipeline and operational execution truly be enough to cross that £40 billion finish line by 2031? Keep a close eye on that R&D pipeline, because that is where the answer truly lies. Thanks so much for joining me for this explainer, and I'll see you next time.